So Alphabet recently had their earnings report and they beat their estimate by 7% and the stock is now taking off. The question is this a stock you should buy now or should you wait for it to pull back at some point in the future? Let's find out. So as usual, we're going to use the 4Ms. We're going to be branding this the 4M Confidence Booster. The reason is you can log in a Tykr and you can take a look at that score, which is overall financial strength of a stock. And you can certainly make a buy or sell decision based on that. But if you really want to take your confidence to the next level, that's when we recommend using those 4Ms. The 4Ms, of course, we look at that margin of safety. That's the math part of investing first. And then we look at the meaning, moat, and management. Meaning is that business model, the revenue streams, how many revenue streams a business has. Then you have the moat, that's how a business stacks up against the competition. And then the management, that's a track record of the CEO. So first things first, let's start with the math. So we're going to dive into Tykr and looking here at Alphabet, we can see this stock is a watch. Ideally, we want to see on sale, but this one's pretty close. So the score is 44, margin of safety is 61. A stock is on sale if the score is 50 or higher and the margin of safety is 50 or higher. So in this case, that score is pretty close, but let's just take a closer look and see what's going on here. What we do, just for context, we look at the fundamentals, so that income statement, cash flow statement, and balance sheet over about 4 or 5 years. The more years we can get, the better. If it's an IPO stock, then we look at just the last few quarters because that's all we can get. But it's still really effective if we just have a few quarters of the income statements. But anyway, looking here in Tykr, we can see the revenues are increasing year over year, which is great. Net income looking pretty good until we get to 2022. Just a slight drop off, still greater than 2020. 19 and 18. We'll talk about the why behind that in a moment. Then we have EPS, which is very similar to net income. Essentially, EPS is just your net income divided by outstanding shares. Jumping over to the cash flow statements, we can see there's a slight drop there. Again, I'll talk about the why behind that, why that did drop off a little bit. And then we jump over to the balance sheet. The assets are a little flat. Liabilities, flat. Debt is also flat, and then equity maybe flat as well. We like to see assets increasing a little more, same with equity, and then liabilities and debts where we want to see those numbers decreasing. In this case of the financial statements, I'd probably say the balance sheet is probably the weakest. It's not the end of the world, but that's why that score is not greater than 50. It's not the end of the world. This is still a strong business from a financial standpoint. And you look here at this fair value, current share price is at 132, fair value at almost $200. And what we do there, what that means is, will this stock get to $200 in the next 10 years? It's a very conservative estimate. The answer is absolutely. But I'll talk about where I think the share price is going at the end of the video. But anyway, with this first M, I'm going to go ahead and check that box. Again, it's watch, but I'm still going to give it a pass. All right, let's move on to the second M. That's the meaning. So Alphabet makes its money really in two main categories. You have Google services, which is 92%, approximately 92% of revenue. This includes Google AdWords, Chrome, Maps, Play, Search, and YouTube. And then you have Google Cloud, which is about 8% of revenue. Google Cloud is the large enterprise hosting platform competitive to AWS and Azure. And some of the customers that actually use Google Cloud include Nintendo, PayPal, Twitter, Macy's, Ulta, Spotify, Renault, Target, AT&T, Toyota, Discovery Channel, Shopify, Goldman Sachs, and the list goes on. So they have some really solid customers. And again, this is only 8% of revenue. This shows that that business model on the advertising side is big. And then let's drop down here to what companies they own. So in another video I talked about, I think Alphabet owns about 200. I did a little more searching on that. It's actually closer to 250 companies. But that's essentially 250 companies that have either been turned into a product or a feature within the platform, or they're actually another revenue stream of the business. We really like business models that are well diversified, a lot of different revenue streams. And I would say Google stacks up really well against any business out there. In fact, my favorite business model, I mentioned this before, is Microsoft. They have probably the widest range of revenue streams, a lot of B2B SaaS, B2C SaaS. They have a lot of different products and features, and of course, businesses generating significant revenue. Second place to that, I'd say Alphabet. Really solid business model. So here's some of the companies they've bought through the years. You have YouTube, Android, Waze, Fitbit, Mandiant cybersecurity, which is really sticky. And then I want to highlight a revenue stream that I thought was, this can be a lot of fun. It's Capital G, which is, they call it a private equity. I would phrase it more as venture capital, essentially investing in businesses. And where a venture capital firm really makes its money is when you invest in a business, you're not making like residuals month over month, year over year, but you make some big returns when that company either sells to another company or goes public. And some of the companies that Capital G has invested in includes Airbnb, Stripe, Lyft, Zscaler, Duolingo, Cloudflare, Freshworks, Glassdoor, Lending Club, and that list goes on. So in this case, really impressive business model in that regard. So overall, the meaning of the business I really like. Now, something I have to highlight, which I mentioned in the first part, why the net income in EPS is down, as well as that free cash flow. And the reason is, when you run into a recession, like we essentially had, some people would say it's more like a bear market over about a year and a half. It was really the end of 2021 through the beginning of 2023. So it's about a year and a half. Again, bear market / recession. What happens is a lot of businesses pull back on advertising. We saw this back in 2008. I remember vividly. I had an agency at the time. We were building software and doing marketing for small and mid-sized businesses, and selling projects was very difficult because everybody's like, nope, we're pulling back our budgets on marketing and advertising. So what happens is, yes, people pull back, but then when the market recovers like it is right now, people start spending on advertising like crazy. And we're going to see that. So I'm going to point out 3 companies here that are really going to see some nice benefits. One being Alphabet because of Google advertising and YouTube advertising. Second would be Meta, Facebook advertising. Third would be Amazon. A lot of other companies out there also make money in advertising. They will see some solid revenue increases as well, but expect those numbers to go up over the next year. So that's a great sign for those who invest in Alphabet. So again, meaning of the business, we can go ahead and check that box. Now let's move on to the Moat. Okay, next up, we have the Moat. We'll use Tykr. I'd like to compare against 4 or 5 businesses. Really good news here. We have the 4M checklist, or 4M confidence booster, coming out with ChatGPT integrated. So it's going to do a lot of the heavy lifting for you and I. I'm going to do this more manual in this case. So I picked out 5 competitors and we want to compare against and see how Alphabet really stacks up. So first off, let's just do a recap on what the numbers look like. We're at watch, scores 44, and margin of safety is 61%. So first off, let's look at Microsoft. We're comparing against Microsoft, really that Google Cloud component against Azure, just to see how it stacks up. So in this case, this is watch. The score is 72, so Microsoft is the better company, but the margin of safety is 0. In this case, I'm going to say Microsoft would be the winner because Azure is a more superior product, definitely with what they're doing with OpenAI, ChatGPT within that cloud hosting platform. Google Cloud is still a great platform, but I would put Azure just a cut above. So in this case, Microsoft, I'd say, is the winner. Let's move on to the next company here, taking a look at Amazon. AWS is a great platform. A lot of big companies use AWS, but we can see here the summary is overpriced. The score is 39 out of 100 and margin of safety is 0. So I would say Google actually beats Amazon in this case as the better overall investment. Next on the list, we want to compare against Meta, that advertising engine, comparing against Alphabet. In this case, Meta is overpriced, scores 44 out of 100, margin of safety of 0. Now, as I mentioned, Meta, they make a lot of money off advertising, but over the bear market recession of 2022 mainly, that's when a lot of companies really pulled back on advertising. But don't worry, for those of you that invest in Meta, that stock is going to see a nice recovery. People are going to start spending a lot more. But in this case, who's the better investment? I would say that Alphabet is better than Meta. Okay, let's compare Alphabet against one more company. We're going with Rackspace. Rackspace is also a hosting company. I've used the platform as well at some of the other companies I work for. Great technology, but from an investment standpoint, check this out. They're overpriced. Scores 44 out of 100 and margin of safety is 0. Another key detail here. Share price is $2.32 US dollars. This is definitely a penny stock. Long story short, any stock that's $5 or less US dollars is a penny stock, and 99.9% of stocks that reach that range between 0 and $5 rarely break out past that point. And then any stock that lands between $5 and $10 US dollars, there's a 90% chance it'll never break out. So this would be definitely a stock I would avoid. So overall, against the competitors here, I'd say the number one investment would be Microsoft, but second place would be Google. So solid group of companies here, but Google, Alphabet is really solid company to invest in when you really compare it against the competitors. So overall, with the Moat, we can go ahead and check that box. Last on the list, we have management. Sundar Pichai has been working at Alphabet or Google since 2004. He actually became the CEO of Google in 2015 and then the CEO of Alphabet in 2019. Really nice track record of advancing through the company, and he's been there a long time. I also like to take a look at Glassdoor to see what other people are saying about the company as well as leadership. I really do like Glassdoor, and I know not everybody can use the platform around the globe, but it's cool to really see the reviews of employees, see what they're saying. So check this out. Score of the company is 4.4 out of 5, which is really good. And the CEO approval is 81%. I like to see anything that's a 4.0 or higher and 80% or higher. In this case, Sundar is doing a really good job as CEO. So in summary, all 4 M's pass. And when I go back to Tykr and I take a look at Alphabet, share price around 132, fair value 194. Can the stock reach 194 in the next 10 years? Absolutely. I actually believe it can hit that price much sooner. We're talking within the next year or two, especially with the direction that advertising is going to go over the next year. So if you're interested in investing in Alphabet, this would be a solid stock to add to your portfolio. Of course, I'd love to hear what you guys have to say. If you like this video, hit that like button. If you want to see more like it, hit that subscribe button. And if you want to learn more about investing and even see stocks like the stocks you saw today, go ahead and join Tykr for free. All right, see you in the next video. Bye for now.